Okay, I think we can go ahead and get started. We will start with introductions, giving additional attendees a chance to join. Welcome to the Synaptic webinar, Measuring and Managing Stress in Lending Portfolios. That is the title. We will actually probably touch on topics much broader than that. But first, let's start with some introductions. Pankaj, over to you.
Hi, Pankaj Kulshreshtha, founder and CEO of Synaptic, about 25 years of experience, everything data analytics, primarily in the area of CRM and risk management. Thank you for making the time to join us. Looking forward to a great session here.
Hey everyone, thank you for joining. My name is Vinay Bhaskar. I lead Credit Risk Solutions with Synaptic. My experience spreads across 2 decades managing retail credit management function, primarily focusing on modeling, stress testing, and risk appetite for large banks.
Great, and I'm Eric Steinhoff. I'll be serving kind of as our MC today. I have, over 20 years of experience in various credit risk management functions, working at both large banks as well as smaller startups and alternative online lenders. Look forward to the discussion today. All right, before we jump into our topic, we did want to kick off a poll. I like to do these just to kind of engage the audience. You should see 4 questions come up on your screen. While you're responding to those, I will walk through just a few level setting slides, some background on macro conditions that should help inform the discussion and the challenges that risk managers face today. So first, this slide is shouldn't be revealing anything that the audience doesn't already know. We all know when COVID hit in March timeframe, unemployment shot up to 15-ish%. Good news is it has steadily trickled down since then, but we're still sitting at a number in the high single digits and likely will through the end of the year. On the right side here, we show consumer confidence levels, which also took a severe hit in March-April timeframe. Losses. Consumer confidence is actually probably at that point was lower than even in the depths of the Great Recession. After a slow rebound, it actually double dips down in that W shape. Since then, we've seen some steady uptick, but we're still well below, 20% below the high levels that were observed right before the pandemic hit. One of the unique things about this recession, every recession is unique. The interesting thing about this one is the disparate impact felt by different industries, from actually a net positive impact for digital platforms, online retailers, SaaS companies, anyone. We all know what happened to Zoom's stock price. We're all using Zoom right now following the pandemic. And so there's certainly been winners and losers in this recession, probably more extreme than in most recessions. On the downside, you have here industrial manufacturing, automotive, services, tourism, anything related to travel have seen big hits. We know, I'm sure all of you have experienced local restaurants going out of business in the last few months, and this has been very much an unequal recession. And then the last slide before we kind of get into the poll results and then our topics of conversation, just wanted to compare this recession versus the previous 2. Probably most of our attendees have experienced at least the 08 and then the kind of 2001 dot-com bubble pop recessions in their kind of adult lifetimes. Current crisis, as you can see, is not just more severe than the prior 2 recessions in terms of at least GDP dip, but also in the rapidness with which the economic contraction happened. So this is, you can see 2008, which was a very severe recession. It actually took several quarters from when the business cycle peaked to the trough. Almost 18 plus months. That's not the case with this recession. We're all hoping for a robust healthy rebound, but the reality is that this one hit quickly and severely, very rapidly. And before we get into sharing the poll results, I think we've got good participation there. I thought we'd each just spend a couple minutes sharing our experience during that '08 recession, because I think it does color a lot of people's approach to, at least from a risk management standpoint, how we're handling today. So Pankaj, why don't you share your experience from 2008?
Sure. My story is a little bit, I actually would like to say that I scooted out of the core period of recession just at the last moment, on the last moment, and I got outside of financial services for a few years, just in the right time. But really, in 2007, I was CRO for a bunch of portfolios in the UK, and I got given this small unsecured loans portfolio that was basically running off. We were not originating anymore. It was created by cross-selling to a base of private label credit card customers. That was the core business. And things didn't look right the moment it came to me. Basically saw that the loss rates were at about twice the average rate that we had on rest of my portfolios. So that didn't feel good. Team came back with their analysis showing that this is going up. The losses are projected to be like 30% loss to sales. And that really was a shocking number, because we were going to lose 1/3 of the total value that we originated. And this was a global company, so I brought it up in our first portfolio quality review, in a quarterly review with the global team, and I pointed it out. I think people didn't pay much attention to that, because they thought this is just a new risk guy trying to pad up some numbers and get an easy life from a risk management perspective. Second quarter, the trends continued. We still showed that vintages and everything is just pointing out to the same trend. And then basically everybody started looking at what's going on here. We basically dug out the old pro formas, which were prepared at the time of starting this loan program, which was 3-4 years ago. And that basically showed that this was planned at 4.5% loss rate, for example, loss to sales rate. And very dutifully, the sponsor of the program had actually done a 20% stress test to say that even if this loss numbers were 5.5%, we'll still hit our ROI hurdles and stuff like that, really. And really, that was lesson number one, especially for times like this. Stress tests can and will go horribly wrong, especially when you have a black swan event like we have right now. And then really what we had to do was, because we were not originating anymore, it's very hard to figure out a way to shrink out of a loss problem. Everybody who's in risk management knows that. So we really just ended up doing a lot of work on collections. Whole of the risk team, instead of doing risk stuff, we started sitting with our collections colleagues and started figuring out ways to restructure loans and do a bunch of stuff to help collections, really. So that was the second thing, just in terms of focus that we had. I think one slight redemption to the whole theme was that we moved some of the good loans that were still performing well onto a growth platform, where we created opportunity to top up the loans and to do some bit of cross-selling for some of the other sales finance stuff that we had on offer. So that really gave us a little bit of balance build, started moving in the right direction. In 2009, I learned from colleagues that were still there with the business that we landed up at 40% loss to sales on that portfolio. That's my story.
A little higher than 5.5.
Right.
Vinay, I think I know you're a little younger than Pankaj and I, but I think you were in a risk function in 2008. Why don't you share your experience?
Absolutely. Well, one, I'm not that much younger, but it's always good to hear that. 2007, 2009, those were still the early years of my career in risk management. And as much as I didn't want to be part of it, I got involved. There was no exit route out. In retrospect, though, I can draw a lot of parallels and perpendiculars to what's happening in today's environment. Looking back, I was part of a global risk management team managing billions of dollars of credit card loan portfolio. And I vividly remember one night where our team got a call from our CRO raising the concern that there's certain actions need to be taken immediately. And the team kind of huddled over a conference call and said, well, what actions? How do we evaluate the performance before we take actions? Which segments do we go after? Their inactive portfolio? How do we reduce contingent liability? And plenty of questions. The only response which we got from a CRO was, at this point, just shoot before you ask. And that's it. He said, there's nothing else that I can tell you. You just need to take action. Well, and the call ended. Next morning, we regrouped, put together a plan on how certain things need to be done, overlay assumptions, and we took action and executed and reduced contingent liability to the tune of about $4 billion on that portfolio, which in retrospect has saved a lot of millions of dollars to the bank. It's now fast forward, I think we're living in a similar environment, a lot of uncertainty. The question that comes to my mind is that, is there a better way to handle this environment, given that we have a lot of data, processing power, plus the experience of the last crisis in managing this, at least the financial response to it. So that's been my experience in this journey.
Yeah, that sounds familiar. Shoot first, ask questions later. I think that is most risk managers' response, and it probably is the appropriate one in the moment. The question is, you don't end there, right? Like, so you, risk managers need to act quickly, but also continue to refine the strategy as more information comes in. And I think Pankaj put it well, you can't shrink your way out of a crisis from a loss perspective. Just a couple minutes on my background and my experience in the last recession. I actually took a new job in early 2008 as a global retail portfolio risk manager, and 6 months after I joined, the crisis hit, and the writing was on the wall. I ended up relocating to the head office of that bank in their Johannesburg, South Africa office, and took over their auto loan portfolio as head of credit there in Q3 of 2009. And so at that point, the losses had already been felt. The origination models had all broken. And what I was actually dealing with, the week I started, they actually deployed a new risk model that they built using the 2008 data. And of course, what happened, the first meeting I remember at least being in that role was sales coming in to yell at credit because approval rates had gone from 50% to 22%. And so I was stepping into a place where credit losses were through the roof, loan loss reserves were extremely high, and originations were effectively dead. And so I really kicked off two initiatives. First, much like Pankaj's, really doubled down on collections and cleaning up that back book, moved more aggressively, repossessed cars, sold them at auction, released loan loss reserves to lighten the balance sheet to allow us to grow. But more importantly, really focused on originations. And it wasn't my idea, but my boss at the time advised me to go and bypass the internal model dev team and go hire a third-party external model build team to speed up the speed to market of building a new model. I think most of us know and have experience with building models at large lenders, and that can be a 12 to 18 month turnaround time. And so what we did was we sped that up. It still probably took 6 months, but went to a third-party modeling build shop, worked with them very closely, made strategic decisions about how to use the 07, 08, and 09 year-to-date data. Launched a model, like I said, about 6 months after I joined, and were able to get those approval rates back up from the low 20s to that 50% mark that had been expected. But it was a very interesting time. And like I said, hopefully we can all leverage those experiences to facilitate our conversation now and provide advice to the audience. Before we jump into the topics we wanted to cover, I do want to share those poll results. You should see them on your screen. I'll read some of them here. First question, is risk management seen as a key strategic priority right now in your organization? Vast majority of you, 74% saying yes. Only 26% or so saying not a big priority. I think that maybe, I'd be curious to hear what people said this time last year, because in a crisis, we all know that risk management gets a seat at the table, but the question is, does it always have one? Second question, what is the most important to your strategic portfolio objectives? About half of you revealed smarter origination. Coming in number 2 was digital customer experience. And we will definitely focus our conversation today on origination strategies and how to handle models and data. Third, do you think your organization is using data effectively? Most of you said partially. And so a handful said yes to the fullest, another handful no, not effectively at all. I think this is consistent with our experience. There's a ton of data out there. It's sometimes hard to know which ones to use, which data sources to use, but at the same time, it's also sometimes challenging to actually access that data to use in making good decisions. And we'll certainly want to touch on that. And finally, when your currently deployed scorecards developed, this one's interesting, pretty mixed across the board. The number 1 answer was, I guess, tied 1 to 2 years ago and more than 3 years ago. And I'm curious to see if people have comments in the Q&A about how those models might be performing given the crisis and the uncertainty. Interesting here that a full 20% of you did rebuild your models during the crisis. And so I'm also curious to see thoughts on how that might work. I'm going to put up our last slide here, and then we can jump into the conversation. These are the 4 themes we want to touch on in this conversation: culture / risk appetite, data, models, and then test and learn. To kick us off, Pankaj, you alluded to some of the culture at your lender in 2007 and the fact that they just assumed risk was sandbagging, which we've all been accused of. Why don't you talk a little bit more about that experience and the role culture and risk appetite can play?
Right. So now that we have, or I have, like 12 years of objective distance from that event, really, I think your perspective clarifies a little bit. And I think when I think about what transpired at that time, it was very clear that risk was not on the table. And I don't mean that they were not involved, but they were not on the table in a substantive manner when the key decisions were being made about whether we should do this in the first place. So this business, right from the start, for example, was a cards and sales finance business, very small ticket sizes, basically very small lines. So lots of subprime, almost new to credit kind of customers were on the portfolio. And here we were offering a large loan with an unsecured loan with a tenure from 3 to 5 years. And the loan sizes were order of magnitude larger than the limits that these people had. So there were very significant design issues where the organization didn't have the native knowledge. And it's absolutely all right to do such things, but what needs to happen in situations like this is that multiple functions need to come and create a worldview and say, here is what is likely to happen. Yes, there are different perspectives on these dimensions of growth and profitability, but let's kind of, agree on certain numbers and then do certain level of testing. So that's, the biggest piece that in my mind that was missing at the time, which is, risk was not substantively involved. I think that changed subsequently. Regulators pretty much mandated that risk be involved. And frankly, I sometimes feel that now the whole culture might have gone to the other extreme of us being the kind of the hurdle to be crossed rather than the collaborators to the core decisions, really. And that's much more of a situation that I would like, the organizations to create in terms of culture. I think another just one quick reminder to everybody, and I think it was very interesting from the survey, Eric, that whole digital customer engagement actually ended up coming, quite high in how people thought about its importance. And it is so true. Just look at the last Economist cover. It is basically talking about the rise of a digital finance, basically. So really, customers are totally getting used to the new dynamic that these e-commerce and the whole digital revolution has germinated. So it's very important that more important than any other time, that risk management become core seat on the table when these decisions are being made. Otherwise, what will happen is we'll create these horror stories of how this particular experiment of lending actually went very badly. And in the interest of community as well as in the interest of lenders, I would like to not create those kind of vivid experiences of blowups.
Fair enough. Yeah, I similarly, have had large bank experiences with risk probably having a suitable seat at the table. It's interesting working at smaller lenders how that role changes, because when you're at a startup that is not profitable from a lending standpoint, not lending or cutting out large segments in the face of anticipated losses is really not an option. Cutting off lending or originations can absolutely kill a business. A startup that requires growth to fuel new fundraising creates a very interesting dynamic in which risk has a seat at the table, but also can't always say no. And what I found myself often doing at both of the small lenders I worked at is really holding my nose on some deals that I would have absolutely killed at a bank, but recognizing that without growth, the company dies. And it's a very interesting, delicate balancing act working at a small lender. In some ways, it's almost easier in a bank where you have silos, and I think you lose some of the strategic interaction and some of that partnership you referenced at a large bank. But it's sometimes easier to play that risk manager role in a large bank where you're responsible for your area and aren't forced to help the company grow, versus at a smaller bank or smaller lender where it's honestly more interesting but much more challenging in my experience.
It'll be interesting. It'll be interesting to do a little of analysis at some point in time about the lifetimes of risk managers at big banks versus smaller lenders. I think both of them are hazardous places for risk managers, but I think it'll be interesting.
Absolutely.
Yeah. Especially on the topic of risk appetite, I think my experience, it is very well structured in big banks. Love to hear your experiences, how important and critical it is for smaller financial institutions. And if not, are there any other challenges they're facing, Eric, from your perspective, that need to be addressed more than risk appetite?
Yeah, I think the challenges at small lenders are numerous. Like I said, it's in my experience more interesting playing those roles because you have to wear multiple hats. At the same time, the limitations are obvious. One of the big ones that comes to mind for me is data availability. And so I know that was one of the topics we had here. I'm going to actually stop sharing because I think we all can see what these topics are, and just continue the conversation. But data availability and the lack of historical performance data at a small lender is a huge challenge. In my experience, you often have to leverage experience from prior roles, experience knowing what are risk indicators, and setting risk appetites, having those conversations. You have to go a little bit, I hate the term gut, but it's gut informed by experience when you don't have data, and that is anathema to a lot of people sitting at large banks, but it is reality. You have to make a decision. Not deciding is not an option, and so filling in those gaps with information wherever available is a huge challenge at a small lender. That said, the availability of data out there today is just exceedingly ample for lenders to use and to tap into. And I know we have a lot of experience using alternative data in building models with our clients. Vinay, I'd love to hear you just talk about your experience with some of those alternative data sources.
Absolutely. I think data, right? Those are the three words that come to mind. It's very critical. I cannot overstress the importance of data, especially if we have to take structured decision making. The data is the key to it. Now, recent engagements that I have been in, plus talking to my risk colleagues at various banks, one of the trends that is evolving is banks and financial institutions tapping into the transactional data that they have. And that transactional data can come in various forms of fashion. One example being institutes which have the saving/checking relationship with the customer, they can kind of create quote unquote a customer 360 profile broadly to say how are the customers doing not just on the asset side of the story, but on the liability as well, right? So aside from the RFM, recency, frequency, and monetary value aspect of it, the transitions and where the spends are being done is becoming very, very critical. And more critical in this environment, Eric and Pankaj and everyone else, than in the previous, because right now, the data that was part of our older strategy is outdated. Financial institutions are seeking for real-time information on what is the status of a customer on employment, status in terms of over-indebtedness, status in terms of whether a customer is able to pay or not. Now, with banks having and financial institutions having so much data, they can create signals or glean through this information to say whether a customer is over-indebted, and that's going to be a leading indicator, a real-time indicator of your performance than waiting for the bureau to update the performance of delinquencies on other cards or behavior. So in my view, tap into the internal data to start with. Of course, there are plenty of augmented data sources available outside. LexisNexis comes to me as a big example of where they collect the non-financial information, FCRA compliant, that can be leveraged to create additional dimension of customer psychographic as well as behavior patterns.
Yeah, I've always been a big fan of LexisNexis as an alternative data source. I've used it at each of my small lending roles kind of in the last 10 years, and I know we'd like to test it when building a model with our clients here at Synaptic. Vinay, you touched on something that I think is very important, which is this whole idea of a customer 360 view and leveraging transactional data.
Mm-hmm.
I think you had a project you worked on with one of our clients to use that information to improve scores. How did that work out?
It's kind of phenomenal success, and just to kind of give a 30,000 feet view of that, the bank, of course, aside from having credit information, had tremendous amount of information on the checking and deposits savings side of the story. One intelligent feature that we created out of that transaction data was to categorize those transactions into discretionary versus necessary spends. Now, not only did it not give us the insights into where the spends are being done, but it also reflects and create a signal to say how responsible a customer is in terms of spending his or her own money on discretionary activities versus necessary, and how the trend has been over time, right? So if a customer has been spending primarily on education, food type activities in the past, but recently started into a gambling space, there surely is a shift in the behavior pattern there. Or people who have remained stable in gambling, you can assess the risk differently. Of course, when using such attributes, you have to be careful of the regulatory FCRA and ECOA concerns, and there's no discriminatory practices. But the point being, there is so much information that institutes know about the customer but are not tapping into. So that was.
And if I may, I had a real experiment that we were doing. I think all of us spend a lot of our mental bandwidth thinking and worrying about what are we missing out in this world of social data, alternate data, and stuff like that. I was with a very senior team combining business leaders and two senior most analytics leaders at a large bank. And they asked me a question first saying, what do you think about a utility of these alternate new age data sources? And I asked them a question in return, which is, first tell me, how much do you think, to what extent do you use your existing data as a big bank? And their answer was, they looked at each other, smiled, and the answer was maybe 25%, if that. So I think, and we have all seen, right, in our work with smaller lenders, it's just amazing how much opportunity is there to just keep data in a proper way, make sure that you kind of don't have to pay for the data that you have already paid for once and stuff like that. So I think we just need to get disciplined about using the data that we have in the strongest possible way we can.
Yeah, how many projects have we all been involved in where we're working with a large lender that pulled bureaus at one point to make these underwriting decisions, and now is going back to the bureau to pay them for a retro for the right to go look at that exact same information again, and often cutting corners to save costs and limiting their sample and the build because of those costs. Yeah, I think it's I think small lenders are probably better positioned for things like that to build data marts, and that's really something to think of. I know it's often easier said than done. At the same time, if not now, when? I think when we're in this uncertain environment, and there are all of these macroeconomic concerns, and that means, in all likelihood, originations is not the top focus. That doesn't mean you shut off originations, but grow at all costs is likely not the mandate right now for most lenders. That, to me, is an opportunity to double down on getting your data sorted and building out those customer 360 views and starting to store and build a data warehouse of all the bureaus you pull for every applicant to inform future model builds, to inform data analytics down the line. And again, if not now, when? I want to pivot a little bit into talking about that third topic we wanted to cover, which was models. I think data ties in nicely. One of the things that has become apparent to me, and I'll use kind of an example as a bridge, is we looked at, we did a proof of concept. I know, Vinay, you led the effort. I was somewhat involved. We built a proof of concept model using bureau data to identify a stability index for borrowers. And so the idea was, can we use bureau variables, and this is not using alternative data, not using customer 360, just limiting ourselves to bureau variables, can we identify those customers who, leading up to a recession, indicated behavior that indicated that they would be more likely to suffer and perform worse in the event of a downturn. So we had a client's data where we were working with a large credit card portfolio. We had data going back to 2007, 8, 9, and we looked at attributes leading into that 08 recession. Pretty obvious things, nothing stood out that would have been earth-shattering. It was things like ramp up of utilization or maxed out utilization or overdrafts leading up to the recession, meaning people who maybe are living on the edge in good times are much more likely to fall over that edge when the economy contracts, credit availability contracts. And that was a real insightful tool that we could use, and that we've worked with some of our partners to use in making better decisions today. But what do you both think about the idea of adapting, updating, tweaking models as real data comes in, as the environment changes? Vinay, what's your point of view on how models may be breaking down today, and how can a risk manager adapt on the fly?
Absolutely. I think the point that you touched upon, Eric, quote unquote resiliency index or a factor is paramount in this environment. And everybody knows the scores are going to be on a higher range when the macro environment is good. Everybody's paying, nothing's bad. But when things go south, there would be categories of scores or levels of score which will dip more than the other. And that's the concept. Rather than evaluating a score as a snapshot and saying, what is the probability of this going bad in 12 months' time? The question is, in addition to that, which scores are more likely to dip from, say, 700 to 600 versus from 700 to 680 if the environment goes south? And that's the art and science behind the score. Now, in this environment, I think one thing which I want to caution or bring for the discussion essentially is this distinction between a model risk and what we call as a chance event, right? And if you allow me to quote the most quoted saying in this environment, which was all models bad, only some are useful, couldn't be more true than it is today. So the point being, we as risk managers need to assess whether it is truly a model risk that we are facing, which means the model is not able to predict the outcome because of the fundamental flaws in the model? Or is it just a chance event, which means the model was built on a past data and it did what it was supposed to do? But the reality is the pandemic is so severe in nature that it was never trained on that data. And it is just that 1% chance that it happened to be that scenario, and the outcome is what it is. Whatever be, so that distinction is important because what actions you take to kind of remedy at that point of time becomes very different. So in a scenario where there is a chance event that the pandemic ensued and all that, the need is to one, of course, calibrate the models on the levels of triggers or independent vectors that you have in your model to the pandemic level so that the model is appropriately tested. Case in point, unemployment rates, if any econometric model was built over the past recent 5, 7, 10 years data, you wouldn't have tested it for 15, 20% of unemployment rates going in there, right? So the model knows what is the elasticity of your PDs or probability of defaults if unemployment goes from 5% to 8%, but it doesn't know what will happen if it goes from 8% to 15%. So either the levels would be erroneous or not at all. The model will not be able to kind of consume. So that calibration needs to occur in real time. That's just one example of it. However, while to do that calibration, the only caution being right now, we are still in the midst of pandemic and we don't know when it's going to end. The data that is required to do that calibration in a more structured way, in a typical modeling parlance, when you have an observation period and a performance stable period and evaluate what unemployment rate did to it, plus the other issue that government interventions and all the CARE Act and the PPP has confounded the impact of what that unemployment rate could have on the delinquencies, right? So we have to wait for the data to be quote unquote good, which I think in the industry I'm hearing it could be around 12 to 18 month period before we get a stable data coming out of this environment, at which point you will start recalibrating your models to tune for that. In the interim, of course, we can't let the models perform as they are, and hence suitable adjustments need to be made to it. And again, talking to my colleagues in other banks, there are various ways to do it. Overlays, adjustment, assumptions. One, in practices, I've seen many banks using the GFC deterioration in the delinquencies during the similar period and borrowing and overlaying on what the delinquencies would be. So that's an adjustment that they're making to the levels they're in broadly.
Yeah, you touched on something that I wanted to recall, a data point. I'd actually used it in one of my previous webinars. But 6 months into the recession or into the pandemic, so around July, August timeframe, we saw that FICOs had actually increased overall. I think the statistic was about 55% of customers had seen, of consumers had a FICO increase, and of those, I think it was close to 20% had a statistically significant increase, so an increase of a score band. And when you break down the numbers, so that may seem counterintuitive at first, when you break down the numbers, the underlying reasons become somewhat obvious. Consumption is down, spending is down, that means utilization is down, and combined with the government intervention that you mentioned, people, even though they may have been unemployed, at least up until very recently, they were receiving some form of check, either a paycheck from a job or a stimulus check from the government, which positioned them to continue to make payments and actually bring loans current. And you know, we've talked to many lenders who have said they actually saw improved risk performance, even in deep subprime portfolios, through the first 4, 5, 6 months of the pandemic. That said, it's given that some of those stimulus checks have dried up, the uncertainty, at least until well after the election, I think, of further stimulus coming, puts lenders in a very interesting position because they haven't yet experienced the losses that they know will come tied to high unemployment. And I like your comment about having rapid dynamic response to the data, and that kind of builds into our last topic around test and learn. Pankaj, what are your thoughts on how a credit risk manager can use test and learn to agilely or rapidly update their strategies and their underlying models?
Yeah, and I think it's I kind of alluded to it even when I was talking about the culture. To me, I think it begins with us as the most, and when I say us, I mean the risk professionals as being the most quantitatively sophisticated folks generally in the community. Uh, we have to first acknowledge and make the business understand the fact that we won't get it right all the time. And that's absolutely okay. As long as we get it right in an operating sweet spot, more often than not, we will be fine. It is impossible to know because there's so many dimensions to this whole thing that are changing, right? You have the whole digital world going on in one direction. You have consumer behaviors are changing. You have a pandemic which is giving all kinds of macroeconomic complexities, including impacting people's jobs and livelihoods and stuff like that. So it's just very complicated environment. And as it has been said, right? Economists, when called into question, they predicted 10 recessions out of the previous three, right? So there is a clear bias that you get with the profession that you call in. And if you call in the business guys, they are like, you would argue that they've, burnt billions of dollars in, lending that was not prudent. So I think this discussion needs to be balanced. And I think tools and technologies now actually exist to do this test and learn. And oftentimes I think there are two challenges that people have. One is the challenge with respect to technology that is required, because technology implementations to do these kind of things have become, in my opinion, disproportionately heavy and expensive. They take too long to do simple stuff. And really now there are examples that fintech players come in, they build a reasonably good platform within 6 months time, really. So it's a wonder to me that we have both things going on simultaneously. On one hand, there are fintech players who are able to create a very innovative platform and start new lending, but at the same time, the real lenders who are experienced at credit are kind of struggling bringing that technology in. So we need to find a solution to that. And I think the second point is just this whole, we had a discussion on models and so forth, really, right? Even with respect to models, and we have, Vinay and Eric, you know that we have done this, right? We have been building. I feel that the lenders have relied too much on PD models, basically, right? Probability of default models, and your credit line is aligned to that, your pricing is aligned to that. Everything is just kind of being solved using that score. I think it's time that we start building activation models, we start building first payment default models and stuff like that. So I think there is just a lot of opportunity, and really, I think the good news is that when I was starting my career, there was only SaaS available, and there were very few people who were trained to build models and stuff like that. Now there are literally hundreds of thousands of people. The process has already been democratized dramatically. So we need to increase the proportion of it that is actually coming into practitioners' toolkit, basically. So I think that's one thing on the model building side from a test and learn perspective that we need to do a lot more. I think the other thing where Vinay talked about it quite a bit, and Eric, you referred to it as well. I think we are past the times where you could just have a very old model or a generic model making decisions for you. You gotta find a way to kind of customize it for you. Even if you don't do a full-blown rebuild of the model, you gotta kind of update or refit the model in line with the incoming population that you have. If you think about it, right, Amazons of the world, new age companies are upgrading their recommendation engines pretty much every week. Basically, they upgrade their engines really based on data. Now, you would argue, and it will be a fair argument to say that from a risk and loss perspective, it takes a little bit of time for the losses to mature. So you need a little bit of maturity, but where is the balance again, right? I mean, how do you kind of do a little bit better than using 4 years or 5 years old applications, which is what we are seeing with most of the cases that we are working with, because that's not representative of what people are getting now in their funnel. So those are some of the thoughts.
Yeah.
This.
I want to. Sorry, Vinay. I want to build on that. I love your comment on the democratization of model building capabilities. First, I do want to point at the time. We're at about 10:45. We'll probably start a Q&A section in about 5 minutes. If attendees, I've seen a couple of questions come in, but please, if you have any questions for us, please go ahead and put those in that Q&A box. And then, Vinay, I'll hand it back to you. Sorry.
No worries. I think as kind of going to respond to Pankaj, those are all valid comments, Pankaj, on the test and learn. And I believe there are two aspects to it. One is the agility in testing and in learning from those tests, which brings to the short model development cycle, quote unquote, part of it. The other aspect is the operational engine behind. So even if the models are developed in 6 weeks time, 10 weeks time, do financial institutions have the capability to test them in a batch mode, real mode, in an agile mode, so that you can learn? So I think that I see as one of the opportunities where financial institutions need to kind of accelerate, but I'm happy to have your view, Pankaj, your experience, and Eric, yours too.
Yeah, I was going to build on that democratization point, though, that Pankaj made earlier. It always surprises me when we find lenders, and we talk to a lot of lenders, not all of them become clients, but we do talk to a lot of them, how many of them are using off-the-shelf models. And I think a lot of that's due to limited data. I've worked at a small lender. If you don't have historical data, I think your first assumption is that a model is not going to be usable. I can't build a model for my population, and that's just not the case anymore. There's so many data sources. We have benchmarks that we can leverage to build at least a initial starting model to help a lender start lending, or if they already are lending, to refine their existing strategy. So that's one piece that I think was true 10 plus years ago and is not true today, that you need lots of historical data to build models. But also, as Pankaj, you referenced, just the tools out there, the number of people who can do it, the ability to build a model very quickly and deploy it on a platform that enables you to make decisions is something that's just new and just wasn't around 10 years ago when I first started getting into the, or I guess 8 years ago when I started working with smaller lenders. I don't know if Pankaj, you want to talk about that a little bit as we wrap up and get into Q&A.
Yeah, just a very quick comment. I think this was comprehensive, whatever you guys were discussing, but I think a very quick point on this is there is a lot of legacy of fear about this whole data science. It used to be an esoteric thing, really, right? So there were these notions that were there about how much data is needed. To me, I'm an insider into the discipline, but I'll tell everybody who's not, is that as Vinay was saying, right, all models are wrong. Probability of a point estimate being correct is zero, obviously, theoretically even. I think it's an empirical question. Models have a certain level of skill. So it comes down to a question of saying, if you are using a standard model or a model that was built at a point of time, and you think you don't have enough data, Eric and Vinay, you know, right, how many times we challenge our clients and say, okay, just give it to us and we'll show you. If it doesn't work, you don't have to bother about it. But pretty much in every single case, we find that we are able to find significant improvement opportunity. It need not be perfect, theoretically speaking, but it works, and that is all there is to these models.
Yep. No, I
can't agree more with that.
Couldn't agree more. Exactly. I think that's a nice point to kind of wrap up on. Again, a reminder to please share any questions you have, and I will just bring that up as a reminder. And I'll start with, we do have three here. First one, I'll ask you, Pankaj, building on this test and learn. So agile test and learn is an interesting concept, but what have we seen any real implementation of it in recent times, and what technology is required to deploy a rapid test and learn short shelf life model?
Yeah, so I think this is not new, right? And Eric, with your Capital One background, you know that these guys Capital One definitely started talking about it more explicitly as information-based strategies more than 20 years ago when they started their business. And it was all built on the concept of testing. Even at that time, at least they were saying that they're doing thousands of tests at any point in time and so forth, really. And I've met several colleagues who think that there's truth to that, really. I think these days this is very common, really. Lots of people are doing this, and lots of very big players are obviously doing some level of testing, but I think even smaller lenders are doing reasonable bit of testing. So there are lots of examples. So for example, I was talking about this concept of saying one of our customers basically has a problem of the first payment itself bouncing. So we said, let's build a separate model to predict the probability that their first payment itself is at risk. And we had a conventional PD model. So if you kind of do a matrix on these two dimensions, then you can think about a bunch of testing opportunities. And in line with your risk appetite, you can actually decide which pockets you want to test, basically. And what we found were some very interesting things. So for example, if you can actually increase, and this is, I'm now going to another example where we were actually working with activation probabilities. And we found that if you actually aligned your origination strategy with a activation score and with a probability of default score, then basically your ability to auto decision large number of customers that have high likelihood of activation actually increases, and our reasonable risk increases. And that actually causes you to have a good pull through. So the longer you keep a customer waiting, the more adverse selection you have, right? And you get bottom of the poll in terms of credit risk on your experience, really. So I think there are a whole lot of tests that are being done. I think from a tech perspective, tech to do this exists and is part of all the conventional, I think most loan origination systems, new age platforms, rule engines like big companies have. So all of that is available in a way. I think the challenge is most of those things I hear from users that they are difficult to operationalize in the business, and they have become the subject matter of technology teams. And when it is with technology team, these projects get prioritized, and prioritization is like, yeah, we'll do this change. This test will be able to implement it after 6 months, but the test won't be relevant in 6 months' time because of the changes we'll see. So I think that's the challenge. So we need more agile technologies to do stuff like that.
Yeah, that's a really good point. That's very much been my experience working at small lenders, as I said. I think there's a couple of challenges at smaller lenders. One of the big ones is just that, getting prioritized as a credit person from a tech standpoint. It seems like all of the IT hours, dollars, et cetera, end up going to anything that's either customer facing or supporting sales, because sales is what keeps a company alive. And so that was always a challenge, is changing any strategies, implementing anything, having to go through that IT prioritization process, and generally not getting prioritized is a big challenge. I do have a long Capital One background. I was there 10 years to start my career. I'm a big believer in test and learn. I'm a big believer in having a test budget. I don't mean by that marketing budget, but I mean, allocating actual risk dollars, actual loss dollars towards testing, maybe incremental on the edges of your strategy, testing into populations that you wouldn't normally approve in a perfect world. But additional sample will inform better models down the line, but also may help you reveal pockets of customers that you can make profitable, maybe not with your existing scorecards or with your existing pricing, but absolutely can tap into as an option to continue to grow. Thought we'd move to the next question. Maybe we'll give this one to you, Vinay. The question is, what opportunities do you think that machine learning can create to deal with the current environment?
Short answer, plenty. Machine learning is not a new concept. It's been in existence for quite some time. It's only its evaluation's been recent, given the data processing capabilities and all that. But in this environment particularly, non-linearity of the behavior is a critical component of mention.
Which are traditional sorry.
Can you guys hear me?
We can hear you. Yeah.
Okay, sorry, I was just switching on. Which the traditional linear regression techniques would kind of miss. So machine learning in this environment, if you're looking at nonlinear patterns, interactions, is a big boost. Secondly, in this agile environment, we need, from a modeling standpoint, a framework that is capable of ingesting new data or dimension as they come through, which machine learning gives you extreme flexibility to play with. So on both those counts, I think it's very pertinent to leverage those techniques and algorithms in this environment more than ever before.
Yeah. Not just to build on that, we've all been parts of many projects delivering models for our clients. We usually, best practices to test multiple modeling techniques, logistic linear regression, along with several machine learning techniques. And I think we can pretty confidently say that every time machine learning will beat a logistic linear regression. And even in some surprising cases where maybe a sample isn't as robust, you're missing some, you don't have necessarily a lot of bads, I still see those machine learning models performing quite well, even when faced with some data challenges. Moving to another question here. As models are built, given the data of the lender, so you're limited to your historical data, how do you handle challenges when you have this one-off event, a pandemic situation? The question says, do we have alerts built in? So have we seen, I think the question is, have we seen examples of models with alerts built in, or how would you handle that, Vinay?
Yeah, so I think two parts to this answer, right? One, what is unknown is unknown, so one couldn't have predicted what we are seeing right now. So that keeping aside, the concept of alerts within the model management framework is kind of very critical and important. So just to exemplify, if your econometric models had the interest rate as the key attribute, and historically you had always seen interest rates going up, right? The interest rates moving only in one direction, or home prices moving only in one direction, if that's your attribute in the model. The reality is that you train your model on that, but in a real environment, it could go down south as well, as we are seeing, right? With kind of near zero interest rates, or the house prices crashing during the GFC period. So if we have a good model inventory management system where not only do we just list the models, but the attributes which are going in there, what direction we expect them to go, on which the model was built, and if that direction changes over the course, such as in pandemic situation, there is an alert to kind of recalibrate or retune the model, because the result of that you will not be able to see immediately. The performance may still be okay. It's only after 6 months down the line you will see that the model deteriorated. So yes, it is very important to have these alerts mechanisms part of your model and inventory management system.
Yeah, I think when we deploy models with our clients, we, assuming they're using our platform to deploy, we always recommend putting in bounds, alerts, traditional monitoring, but also anomaly detection tools to see if the models either the inputs look like something that was not seen in the train set, or the outputs are producing something that was not seen on the train sample. We have 1 minute left. There's one last question I'd love to get to, because I think we have a good answer for this. What is the optimum model performance time? Companies claim 3 weeks to 3 months these days. What has our experience been? Machine learning can definitely push the time limit, but can it be trusted completely? Pankaj, I'll let you wrap up with that.
Yeah, so I think it's an empirical question, and I think there is a broader question here that everybody should be aware about. That there are, machine learning has become such a topical thing that there are lots of people that have jumped into it. So I think there is this issue about what is credible. There is this issue about what is really possible. So there is, but that's probably a separate topic for another discussion or webinar at some point in time to determine what questions to ask so that you can figure out who are the people who really know about this. Now, I think using the techniques that are available right now, a few weeks is absolutely possible to build these models in. I think the bigger challenges are at the two other outer spectrums of the core statistical process that building model requires. One is preparing the right kind of data. And I can't tell you how often we pretty much in every single case, you all are familiar with how much work do we have to do with the clients to make sure that the data that is coming is suitable to be actually, to actually be able to train a model, a statistical model of any type. So that's one big piece of work that has to be done. And quality of that work is everything. You will end up building models that are really, I mean, it's like, garbage in, garbage out. And I think the second thing is at the tail end of it, really, just making sure that model is fit for the purpose, that it meets all regulatory requirements. It doesn't do redlining and all kinds of stuff that regulators are worried about. Putting it through a model governance framework and stuff like that. Those are the things that take more time. And I think if there is will, I think that time can be significantly crunched. We have been able to get through with this process within, 6 weeks, I would say, in some of the cases. But it does take.
Yeah, I think it's a great point to wrap up with. Yeah, the data prep side can take as long or as short as the quality of the data enables. The model build time has been compressed significantly, but that is only that 1/3 component. So there's the data prep time, the model build time, and then the governance, documentation, validation, all of that. And those continue to extend depending on the lender and the quality of data and robustness of the review. But yes, we definitely have deployed models in 6 months or less, and the constraint is never the model build component. Awesome. Well, we are 2 minutes over. Thank you very much, Vinay and Pankaj. Thank you all for attending. We appreciate the input, and it's been great.
Thank you, Eric, and thank you, everyone.